Trump got his own guy into the single most important financial seat in the country, the one job that can move every interest rate you pay, and he did it for one reason: to cut your interest rates. Kevin Warsh is the new chair of the Federal Reserve, handpicked, sworn in, ready to go. His very first meeting where he could actually pull that lever is just days away. And then, right before the door opened, the economy walked up and slammed it shut. The rate cut you were promised, the one that was supposed to make your mortgage cheaper and your car loan easier and your whole financial life lighter, that cut is not coming. Not this month, maybe not this year. And here is the part nobody is telling you. There is a way to actually win from this if you understand what just happened. So let me walk you through it, friend to friend, because there is real money on the table here. Let me take you back to May 22nd of this year. That is the day Kevin Warsh raised his right hand and officially became the chair of the Federal Reserve, taking over from Jerome Powell, who ran the place for years. Now, this was not some quiet bureaucratic handoff. Trump wanted Warsh in that chair, and he was not exactly subtle about why. He wanted lower rates, and he wanted them fast. He was eyeing the very next Fed meeting, the one on June 16th and 17th, as the moment it would all happen. At one point, Trump even joked that he would sue Warsh if the man did not lower rates. Sue him. That is how badly he wanted this. Imagine starting a new job where your boss is publicly threatening legal action if you do not do the one thing he hired you for before you have even sat down at your desk. So that was the setup. New chair, clear marching orders, a deadline circled on the calendar. On paper, it looked like a done deal. Trump had spent enormous political energy getting his man into position precisely so this rate cut could happen. Everything was lined up. And then the economy did the one thing nobody in the White House wanted it to do. It got strong. Annoyingly, inconveniently strong. To understand why that matters so much, you have to understand where rates actually sit right now. The Fed funds target range is sitting between 3.5% and 3.75%. They held it right there at the last meeting under Jerome Powell back in late April. So this is not some emergency level. Rates are already meaningfully high, which is exactly why Trump wanted them brought down. Every notch lower would ripple straight through to mortgages, car loans, credit cards, business loans, the whole economy. The lever Warsh controls touches almost every dollar that moves through the economy. That is why this one meeting matters so much, and that is why the timing of the data could not have been worse for the people hoping for a cut. Here is where the trap snapped shut. In the days leading up to Warsh's first meeting, the data came in, and it did not cooperate. Start with inflation. The most recent inflation report showed prices rising at 3.8% over the past year. That was up from 3.3% the month before. So inflation was not cooling off and drifting back down to where the Fed wants it. It was climbing back up, going the wrong direction. And the month-to-month number jumped 0.6%, which when you stretch it across a full year is a pretty hot pace. Now, some people will say, hold on, a lot of that is just volatile stuff like food and energy bouncing around. Fair point. So let us look at the cleaner number, the one the Fed actually pays the closest attention to. That is core inflation, which strips out food and energy to show the underlying trend. Core prices rose 0.4% in that single month and 2.8% over the year. And 2.8% is still comfortably above the 2% target the Fed is aiming for. So even when you cut out the noisy stuff and look at the clean signal underneath, inflation is still too hot. There was no hiding place in that report. Whichever way you sliced it, prices were running warmer than the Fed wants. The inflation number was just the first punch. The second one landed even harder. The May jobs report came out on June 5th, and it was a blowout. The economy added 172,000 jobs that month. Now, you might be thinking, okay, is that a big number or not? Here is the context that matters. Economists were expecting somewhere around 80,000, so the actual number came in at more than double what the experts predicted. It beat every single estimate on Wall Street. Not most of them, all of them. And it was not just a fluke in one corner of the economy either. The gains were spread out. Restaurants and hotels led the way, adding around 70,000 jobs, with food services alone responsible for roughly 48,000 of those. Local government picked up about 55,000. Healthcare added another 35,000 or so. Even manufacturing chipped in a bit. That kind of broad-based hiring is the sign of an economy that is genuinely humming, not one teetering on the edge and begging for help. And this came right after April, which itself was revised up to 179,000 jobs. So 2 strong months back to back. Unemployment held steady at 4.3%, which is historically low, and wages kept climbing, up 0.3% for the month and 3.4% over the year, which means people have more money in their pockets to go out and spend. Good for your paycheck, sure. But more spending power chasing goods is exactly the fuel that keeps inflation alive. And that, right there, is the problem for anybody hoping for a rate cut. Let me explain why, because this is the part that actually matters for your money. The Federal Reserve cuts interest rates when the economy is weak and needs help. Low rates are like pouring gasoline on a fire. They make borrowing cheap, they push people to spend and businesses to hire, they heat everything up. That is great when the economy is cold and sluggish. When inflation is already running at 3.8% and the job market is this hot, pouring more gasoline on it does not help you. It just makes prices explode even higher. So Warsh is stuck. If he cuts rates into an economy this strong, he risks sending inflation roaring back, and then everybody pays more for groceries, gas, rent, everything. The data took the decision out of his hands. He could be the most loyal appointee in history, and it would not matter because the numbers are screaming the opposite of what Trump wants. And the markets figured this out almost instantly. After that jobs report dropped, traders went from expecting cuts to expecting basically nothing. Right now, the market is pricing in about a 99% chance that the Fed does not change rates at all at the June 17th meeting. 99%. That is about as close to a sure thing as you ever see in finance. And it gets wilder. There is roughly a 75% chance the Fed cuts rates 0 times in all of this year. Not one cut. And a few policymakers are not just talking about holding steady. They are quietly floating the idea of a rate hike, raising rates, the exact opposite of everything Trump installed Warsh to do. Even Trump seemed to read the room. After all that talk about suing his own Fed chair, he softened his tone, saying he wants Warsh to be totally independent and, quote, I am going to let him do what he wants to do. Which is a pretty remarkable walk back when you remember the whole point was to get him to do one specific thing. And to his credit, Warsh has not been completely closed off to the idea of lower rates down the line. Back at his confirmation hearing, he suggested that gains in productivity from artificial intelligence could eventually create the conditions for rates to come down. The logic there is interesting. If AI makes the economy more productive, you can grow without prices overheating, and that opens the door to easing without lighting the inflation fire. But notice the word eventually. That is a someday story, not a June story. It does not help anyone hoping for relief at this meeting. It is the kind of thing a careful central banker says to leave himself room without making a promise he cannot keep. Now, if you are getting value out of this breakdown, do me a quick favor and hit that subscribe button. We do this every single day, taking the biggest money story in the country and breaking down what it actually means for your wallet. Daily. So if you want to stay ahead of this stuff instead of finding out after it already cost you, subscribe and stick around. Right, so here is where things get really interesting, because we have actually been down this exact road before, and history left us a pretty clear lesson. Back in the 1970s, the Fed faced a version of this same trap. Inflation was a serious problem, and there was enormous pressure, political and public, to cut rates and make life easier for everyone. And for a while, the Fed gave in. They eased up too early before inflation was truly beaten. It felt good in the moment. Borrowing got cheaper, the economy got a little jolt. But then inflation came roaring right back, worse than before. So they would tighten again, then loosen again, this stop-and-go dance that dragged on for years. The whole painful saga taught central bankers one lesson they have never forgotten. If you cut too soon, you do not solve inflation. You feed it, and then you have to fight the same battle all over again, except harder. That is the ghost sitting in the room with Kevin Warsh right now. He knows that history. Every Fed chair does. Putting rates into 3.8% inflation with a red-hot job market is exactly the move that blew up in their faces decades ago. So even setting aside all the politics, even if Warsh wanted nothing more than to make his boss happy, the lesson of the past is a giant flashing warning sign telling him not to do it. The trap is not just political, it is historical too. So let me get to the part you actually care about. When rates stay high, who wins and who loses? Because there are very clearly two sides to this, and which side you end up on depends entirely on what you do next. Let us start with the winners, because there is genuinely good news here for a lot of you. If you are a saver, if you've got cash sitting around, you are in a great spot. When rates stay high, the interest you earn on your money stays high too. High-yield savings accounts, certificates of deposit, short-term treasury bills, all of these are paying out real, meaningful returns right now in a way they simply were not a few years ago. The 10-year treasury is yielding around 4.48%. For years, your savings account paid you basically nothing, a rounding error. Now your cash can actually work for you while it sits there. That is a gift. And it is a gift with an expiration date because the moment rates do eventually come down, those juicy yields shrink right along with them. And it is not just the 10-year. Even shorter-term treasuries, the 2-year, for example, are paying around 4.16%. So whether you want to park money for a couple of years or a full decade, you can lock in returns that genuinely move the needle. The point is, a high-rate environment is brutal if you owe money, but it is a quiet windfall if you have money saved. And most people never flip that switch in their head. They hear high rates and assume bad news across the board, when for savers it is the opposite. Now the other side, who keeps feeling the squeeze? If you are a borrower, this is tougher news. Anybody carrying a credit card balance, anybody hoping mortgage rates would drop so they could buy a house or refinance, anybody with a car loan or thinking about a big purchase on credit, you are going to keep paying these higher rates for a while longer. Relief a lot of people were banking on just got pushed further down the road. It is frustrating, no doubt about it. But knowing it is coming means you can plan around it instead of getting caught off guard. And there is one more group exposed here that you might not think about: the stock market. A big chunk of the market has been priced for rate cuts, meaning investors already baked in the assumption that cheaper money was coming to boost stock prices. When that assumption gets ripped away, some of that optimism has to get repriced. Even gold, which had been sitting up around $4,300 an ounce, pulled back on the strong jobs news as yields in the dollar pushed higher. A lot of people pile into gold expecting lower rates, and when that bet looks shaky, gold tends to feel it. So that is the landscape. Here is what you actually do about it, and this is the part that turns all of this from scary news into an opportunity. First, if you have got cash, lock in these high yields while they are still here. Open that high-yield savings account. Look at a CD or a short-term treasury. These rates will not last forever, and right now you can grab returns that savers spent years dreaming about. This is the silver lining of the whole story, and most people are going to sleep on it. Do not be most people. Second, do not bet your portfolio on a rate cut that the market is telling you is not coming. If you have been holding off, waiting for cuts to make some move, or piling into investments purely because you assumed cheap money was around the corner, take a hard look at that. The smart play is not to gamble on a timeline that the data just blew up. Third, and this is the boring one that actually builds wealth, keep investing consistently. Do not try to perfectly time the Fed. Nobody can, not even the people who work there. Keep putting money in steadily, month after month, through the noise. That consistency beats clever timing almost every single time. And fourth, watch 2 dates. The next inflation report lands on June 10th, and that number will tell us whether prices are still climbing or finally cooling. Then the Fed makes its actual decision on June 16th and 17th. Those 2 events are the real triggers, the moments that will move your money. Now you know what to look for and what each outcome means, which puts you miles ahead of everyone who is just going to react to a scary headline after the fact. So here is the full picture. Trump installed a new Fed chair to cut your rates, and the economy itself, strong inflation and a booming job market, took that decision right out of his hands. The cut is not coming, at least not now. But you are not powerless in this. The same high rates that frustrate borrowers are handing savers the best returns in years, and you have a clear, simple game plan to come out ahead. The people who understand this moment are going to use it. The people who do not are going to get blindsided. And the only difference between those 2 groups is whether you actually do something with what you just learned. We break down the biggest money story in the country every single day in plain English, so you always know what it means for your wallet. If that is the kind of thing you want in your corner, subscribe and come back tomorrow. Stay smart with your money, and I will see you in the next one.